Alright, in this video we are going to prepare a bunch of journal entries recording the costs of these 3 jobs here. And then we are going to prepare a very simple income statement at the end. So it says Kathy's Catering Company uses a job cost system. Its activities in November, or the first month of operations, were as follows. So they have jobs First Rate University, Active Life Home, and Precocious School. So they've given us the direct material costs for all the food. So the only thing we have to do there is add them all up. So I'm going to use the auto sum feature, and it's going to automatically sum those up for us. So $171,000 is the total direct materials cost. It's also given us the direct labor cost for all 3 of the jobs. And again, all we have to do is sum those up. It's given us the labor hours, so we have to read further to figure out what we're supposed to do with those. It says the company applies overhead at a rate of $16 per labor hour. So that's why they gave us the labor hours. We've got to calculate the predetermined overhead and apply it. So we just have to multiply the $16 per labor hour by the number of labor hours to come up with the amount of applied overhead. So I'm going to do that on this next line. Applied overhead. And we're going to tell Excel that we're going to do a formula, and the way we do that is we enter an equal sign, and I am just going to multiply the 2,900 labor hours times $16 per hour to get total overhead applied to this First Rate University of $46,400. And then I'm just going to do the same thing here. 3,500 direct labor hours times 16. It's $56,000. And for Precocious School, it's 3,800 direct labor hours times the $16 per hour. So that's 60,800. So now we can sum up all of these to get our applied overhead. Right, and the very last thing we want to do is add up our total job costs. And we're going to want to tell Excel again we're going to do a formula. So equal sign plus the materials plus the labor plus the applied overhead. And then you just click enter. And now I can copy that formula simply by dragging it across. And I get total job costs. I'm going to enter a space here just so there's a little more clarity. So I get total job costs for First Rate University of $145,400. For Active Life Home is $132,500, and for Precocious School is $195,800. So the total for all of them is $473,700. Let me underline these. So again, just to give it some clarity when we start making these journal entries. Okay. So I've kind of already recapped all these down here. So the first thing we have to do is prepare the journal entry to record the direct materials used. And that was the $171,000. So let me just direct materials used. And we're going to put that in our work in process inventory. So we're going to abbreviate that as WIP. Okay, inventory is an asset. So in order to increase that, you have to debit it. Because we just started these jobs. And I need to credit the raw materials inventory, because when we buy the materials, we put it in our raw materials inventory. Then when we use it, we take it out of the raw materials inventory and put it in the work in process inventory. So since we've used 171,000 of those materials, we have to increase our work in process inventory and decrease our raw materials inventory. They're both assets. So in order to increase it, you have to debit it, and decrease it, you have to credit it. The next journal entry is asking us to do is prepare the journal entry to record the direct labor used. And we just added that up. Label it for us. And it's $139,500. So again, anytime we use labor that's directly traceable to the product that we're producing. It will be a direct labor, and so that again increases our work in process inventory. So it's $139,500. And the credit is always to factory payroll, because when we pay the payroll out, we record it to factory payroll. So in order to get rid of it, we have to credit it. And this journal entry says prepare the journal entry to record overhead applied. And that is the 163.2. Overhead applied. So again, that is a work in process item, because it is what we had to use that wasn't a direct material or a direct labor. We talked about this in a previous video. The three items that make up product costs is direct materials, direct labor, and manufacturing overhead. So anything that's used in the production of the asset that we're going to sell later, the product, if it's not direct materials and it's not direct labor, then it's going to be manufacturing overhead. And we are going to credit manufacturing overhead. So we calculated that already. It's 163.2. And now it's asking us to prepare the journal entry to record the jobs completed and transferred to finished goods. So up here it says all jobs are completed in November. So the total cost, $473,700. I'm just going to label these completed jobs. They completed them all. They started them all in November and they completed them all in November. So we are going to now take all those costs that we put in work in process inventory. They're not work in process anymore. We finished them all. So we need to put them in the finished goods inventory. When you get to manufacturing companies, you'll have 3 inventory accounts to keep track of. Your raw materials inventory, your work in process inventory, and your finished goods inventory. Once the goods are finished, they are taken out of work in process, because again, they're no longer being worked on. They're finished, and put them in the finished goods inventory. So our total costs were $473,700. And we're increasing one asset and decreasing the other. Now this journal entry says prepare the journal entry to record the sales and the cost of goods sold entry. So it says total revenue for the 3 jobs was $400,000. So we need to, I'm going to assume it was on accounts payable, accounts receivable, that they didn't pay us cash. And I'm going to credit sales, because in order to increase sales, you have to credit it. And again, it said it was $400,000. Whenever we record a sales journal entry, you know we have to also take those goods out of our inventory, because now they're no longer ours, right? We've just sold them. So we have to take them out of our finished goods inventory and put them in cost of goods sold. So cost of goods sold is increased with the debit, and the finished goods inventory, since it's an asset, is decreased with a credit. And we already said that the cost of those 3 jobs that we produced is $473,700. So we're going to move those costs out of our finished goods inventory and into our cost of goods sold, because that's what it cost us to produce them. So you can see right here, we sold them for a loss, right? If we only sold them for $400,000, but it cost us $473,700, then when we get to the income statement, we know we're going to have a loss. Let me put a line in here. And then it says prepare the journal entry to record the actual overhead using the information provided above in the problem. So we need to go back up here and see what they tell us that was. It says actual overhead for the month was $160,000, of which $120,000 should be credited to accounts payable and $40,000 should be credited to accumulated depreciation. So we need to record the actual overhead. So we are going to debit manufacturing overhead. And it said part of it gets credited to accounts payable, and the other part gets credited to accumulated depreciation. So our manufacturing overhead was $160,000, it said, and then it said accounts payable was $120,000, and the depreciation was $40,000. And the next journal entry says prepare the adjusting entry needed to correct any under or over applied overhead. So the first thing we have to do is say, okay, our actual overhead we just recorded was $160,000, and our applied overhead, we'll have to go back up to that journal entry and see what we applied. Let's see. Our applied overhead is right here. Prepare the journal entry to record the applied overhead. And we also calculated it up here. Remember, we took the labor hours and multiplied it times the $16 per hour that we calculated. So we could also pick that number up from here, the applied overhead, 163.2. So are we over or under applied? Well, we applied more than what we actually incurred, so we're over applied. How much are we over applied by? You just subtract the two. So we are over applied by $3,200. We applied more than our actual costs were. Remember, this applied is just an estimate, or best guess. So we have to prepare a journal entry to correct that. So we need to debit manufacturing overhead because we put too much in there when we estimated. And we're going to credit cost of goods sold. Whenever you're correcting for over or under applied overhead, it's always going to be manufacturing overhead and cost of goods sold. It just depends on whether you're over applied or under applied, whether you're going to debit which one. So if you're over applied, you're going to debit cost of manufacturing overhead and credit cost of goods sold. If you're under applied, you're going to do the opposite. You're going to debit cost of goods sold and credit manufacturing overhead. So we said that was $3,200. And now the last step is to prepare an income statement. I've already kind of laid it out here. So it told us our sales, and we could look back up through the journal entries. Our sales was $400,000. Our cost of goods sold was $473,700, and it's going to be a subtraction, so I'm going to go ahead and put it in as a negative. And so our gross profit is just our sales minus our cost of goods sold. So I'm going to do that by calculation in Excel. All right, equal sign tells Excel I'm getting ready to do a formula. And so I entered equals, and I put in the sales, and I subtracted the cost of goods sold. But cost of goods sold is already entered as a negative, so I just have to do the plus. So we have a gross loss, not a gross profit, of $73,700. We'd already talked about that when we did the journal entry. Selling and administrative expense. Don't believe they gave us any, but let's go up and double check. There's no selling and general administrative expense there. And there's no selling and general administrative expense here. So we can assume that it's zero since they didn't give us any. And then to come up with your net income or net loss, you just take your gross profit and subtract that zero. So it's going to be a negative $73,700. So we have a net loss. It's our first month of operations, it said at the very beginning. So they have to get their processes down and their pricing down. Evidently their pricing was a little low because they only produced 3 jobs and they had a loss of $73,700. But that's very common for new businesses to lose money the first year or two, actually. Okay? So that is preparing journal entries. You will have a homework problem similar to this. There'll be a few more journal entries to enter, but this should give you a good base to go off of.